Yeah, exactly.
That's true. Raymond James Financial reporting record third quarter earnings last night after the closing bell. Results coming in above expectations. We want to bring in Raymond James CEO Paul Reilly right now. Talk more about the quarter and what he's seeing. Good to see you, Paul. Thanks so much for joining us.
Good being here, Maria.
Can you characterize the quarter for us? How was it?
Yeah, I think it's a very good quarter. We had record revenues. We missed record profits by about $3 million, so our second best quarter. But more important were the drivers going forward. We hit $500 billion in assets under administration. We had record recruiting quarter, 123 net new advisors, and more importantly, our attrition is very, very small, with less than 1% of attrition of our existing advisors, which is a testament really to the culture.
What are you seeing in terms of the sentiment of investors right now? When you look at the flows and where people are allocating capital, do you see a risk adversity out there? What's the sentiment in terms of clients today?
You know, not so much. In our surveys, a little over half, I think it's 56% are positive on the U.S. economy, but 2/3 are positive on the market still. So if you look at the net allocations in portfolios, equities are up in the mix, but a lot of that's appreciation versus really added investments. And you see a lot of the stocks still domestic and some in the developed overseas markets, but equities people have held in there pretty strong.
Yeah, for sure, and that seems to be one of the better places to be, frankly, given this low rate environment. Do you expect the Fed to raise rates this year, and how do you think a rising rate environment changes things, Paul?
Well, I would have expected the Fed to raise rates before this year, but I think they will, maybe just to show that they can. That I think the rates need to float back to a more normal environment. Certainly retirees and people living on fixed income have been taxed really by artificially low rates. So I think they'll rise, which I think will be good for consumers and good for companies like ours. We will certainly make a lot more money, and our clients will too, in a rising interest rate environment. On the flip side, you have to be careful on long-term fixed income investments, where clients have been bringing down their exposure.
Here's Keith McCullough, Paul.
Yeah, Paul, I was just going to make a simple point in agreeing with you on they should have raised rates. I completely agree with that. When the economy is accelerating, in 2013, for example, the Fed was setting up to raise rates, and they kept pushing, delaying. Now we have a slowdown. You nor I have never seen the Federal Reserve tighten into a slowdown. So I get in this debate with clients a lot, institutional clients, your clients, what they should do versus what they should have done. What is the risk of them making the second mistake? Not raising rates already has been the first. What if they raise into a slowdown?
I think the economy is vibrant enough that it will continue to expand. So I don't think there's a risk. They can raise rates, and they can always bring them back in. And they could go to QE17, I guess, or whatever they do. But so I think the exposure is limited. I do think to show that the economy is resilient and can absorb a small interest rate, I don't think there'll be any big hikes, but I think it'd actually be good for the psyche of people in the economy to say, hey, rates can go up, and no one's expecting a runaway rate rise. And, I think a small, modest rate rise to show the confidence in the economy will be a positive.
But both of those things have never happened before, to be clear. I mean, if I'm right, and this is the debate, if I'm right on growth, they're going to be raising into a slowdown. If you're right on growth, they're going to be raising into, something that's a little bit more bullish. But they'd also then, you said, could cut immediately. The Federal Reserve has never raised once and then immediately cut. So that, there's a couple things that you said there that have never happened before.
I agree with you. So I don't know what they'll do. There have been a lot of things that have never happened before since 2009. So we're into new territories, and we'll just have to see what they do. From my standpoint, economically, they should have raised rates. I can understand some hesitancy now. But honestly, if you look where the markets are, rates are still artificially low.
Mm-hmm. How are you deploying capital right now, Paul, in terms of the growth story at Raymond James? How does the firm look different in the next 3 or 5 years, and how do you invest in that period?
Yeah, well, I'd say it's more of the same. We've been a large organic recruiter. We have over 250 new advisors net this year. So we continue to recruit, and much bigger teams in our private wealth business. So we had a team of $15 million join us this year. So we've expanded, really focused on the Northeast and the West where we hadn't been. So we have a lot of organic growth. We do look at niche acquisitions all the time, but we're very conservative. If the culture doesn't fit and we don't think the price makes sense, we just back away. So we're very aggressive in looking. And then we're when there's areas like Morgan Keegan, when we did that acquisition 3 years ago where the cultures fit and we think the terms are right, we'll move very quickly. So we would like to grow organically, but we're very aggressive at looking at niche acquisitions and just haven't really closed in on one that's fit all of our criteria yet.
Hey, Paul, Sandra Smith here. Thanks for being with us this morning, and congratulations on the the record revenue number there. The political environment is everybody's talking about it right now, and obviously Wall Street comes up a lot with the current candidates and their campaigns. There's targeted messages on Wall Street. There's attacks on Wall Street. There's talk of more rules and regulations being thrown at Wall Street. How important is the political environment and the changes that may be coming to your business?
The political environment's important. So we've operated very low leverage and very conservatively. So although the rules impact us less, they do impact us and our consumers. So I really believe that the industry's been over-regulated, and it's not, the principal regulation was good. You know, capital, leverage, transparency, were all good in Dodd-Frank. But there's so many rules from different regulators overlapping. The latest is the DOL proposals, where it looks like we're going to have some constructive conversations, at least hopefully, before the rule is finalized, is that, you know, we need to have rules that work for the client. People forget about the consumer. What rules really benefit them? And if it's just what they can't do, not what they should do, we lose a little focus. So hopefully the environment will level out. But, you know, from a political standpoint, it's good to beat up on Wall Street politically. You know, the messages, we're here to protect the consumer, are right. We are here to protect the consumer. But I think it's an unfair characterization that firms in our industry aren't very consumer focused.
Yeah.
We are, and I know many of our competitors are.
Absolutely. And we know that whole rhetoric has worked, unfortunately. Paul, good to have you on the program today. Thanks so much.
Thank you, guys.
We'll be watching. Paul Reilly joining us there, CEO at Raymond James. Coming